It's been a very interesting journey, and I would tell you it's been about transforming the company, and it has not been a task only about finance or the finance team. It's a company-wide effort. Throughout this period, the company has had to rethink its organization in terms of efficiency. We've had several rounds of reorganization, thinking about not only about how we can cut costs, but also how we can operate more effectively, more efficiently, empowering more people around the world in our operations, which means implementing and deploying a culture of high degree of empowerment, but also high degree of accountability, reducing layers, etc. No? It has also been about thinking strategically about our portfolio. We have, as a measure of making progress towards strengthening our capital structure, decided to embark on divestment programs. So we have had to be very selective about which assets we can sell by having a portfolio of assets to dispose that meet a very robust disposal criteria. No? That has to do with the strategic fit of those assets in our portfolio. It has to do with potential buyers and whether or not there will be people that will want to pay full value for those assets, and also the return profile those assets represent to CEMEX. So it's been a journey that has cut across many angles of the business, operationally, strategically, and then also there's been a good element which is financial. No? It's been about protecting the value to our shareholders, but also inevitably we had to incur in equity raising initiatives which ultimately dilute our shareholders, but it's something we had to do to respond to the big challenges that we faced. We've had to confront very complex refinancing efforts with our core banks. So creating a track record of being predictable, being very clear about what we want to do and what we're not about to do, and then delivering on our commitments has been extremely useful. No? So it's been a wide array of things that we have had to focus on across the board in the company. Well, we actually are in the middle of an asset divestment program for 2016 and 17, which we have targeted for raising between $1.5 to $2 billion worth of assets. So the transaction that we announced to sell one of our cement factories in the United States, in Ohio, to Eagle Materials is just one of a few of the assets that we're going to dispose, or we are disposing this year and next year to get to the $1.5 to $2 billion target. The purpose of the raising proceeds from asset sales is basically to pay down our debt, because an overarching objective the company has right now is to reduce its leverage from levels of around 4.75 right now to under 3 times. And selling assets is one of a few of the components that are going to help us get there. No? So the asset sales to Eagle Materials, asset sales also we announced to Grupo Cementos Chihuahua also in the United States, the sale of our minority stake in the Philippines earlier this year, all contribute to this objective and will help us raise proceeds to pay down our debt. To respond to your question about CapEx, we are deploying around $600 to $700 million of CapEx annually, and the funding source for that CapEx is internally generated free cash flow. We are very satisfied and very pleased about the performance of our portfolio. In very challenging economic landscape around the world, we have a portfolio that is delivering growth both in demand or in sales volumes and also in pricing. So we have a combination of volume and pricing growth. We're seeing margin expansion because of the operational leverage in our business. And all that is translating to higher cash flows, which in turn, together with our asset sales program, is generating sufficient funds in the company to bring down our debt, which in effect does impact our capital market strategy. The name of the game for us over the past few years was access to markets and liability management, rolling over our debt to extend tenor, etc. The challenge that we face right now, as we speak, is how to more effectively bring down our debt and pay which debt instruments to pay. We have had to implement a couple of tender offers to retire some of our bonds this year. So yeah, we've had to make adjustments. Access to market currently, right now, is not the key priority. More so right now is how to more effectively deploy the surplus cash and the asset sales proceeds that we're generating to pay down our debt. Probably the biggest challenge has been the access to market, right? In the context of a very high degree of volatility that we have seen in the capital markets, sometimes we've seen markets close down almost for up to a year. And when we are a frequent issuer, when we have significant refinancing needs, access to market is extremely important. No? So one way we have mitigated the risk of not having access to market is by being very proactive and by anticipating our maturities almost 2 or even 3 years. No? So by virtue of having very little maturities over the next 24 months at any point in time, provides us a significant cushion and isolates us from the risk of not having access to market. No? And the other thing we have done is to always be prepared. When the market is closed, you never know when the market is going to be back and running again. So being prepared all the time has proven to be very effective, because suddenly when markets open, we're there and we can tap the markets. No? I think it is very important to have a very robust communication strategy with the market, engaging the market participants, banks, rating agencies, and of course the investors is very important. Being present in the multiple conferences where investors participate, building the brand name in the capital markets. And of course, behind all of this is to have a robust strategy and ensure that you are working to build and protect the company's reputation in the market.